Welcome. This part of the presentation is on capital gains versus ordinary income. Most of you know, my name is Roman Basie. I'm an attorney and CPA. I do tax planning, succession planning, and estate planning across the country for clients, as well as tax return preparation for clients across the country. So let's start today's topic. We're going to talk about the difference between capital gains, ordinary income, and all of the things that come into play when we deal with capital gains, like 1031 exchanges, buying and selling companies, buying and selling assets as a whole. Your clients are going to come to you and say, well, can I get a capital gains rate on this tax issue? And you're going to have to be able to talk about that with them, analyze that to see, is this an ordinary income item or is this a capital gains item? Take a look. Capital gains, I'm on slide 2. Capital gains generally have better, what we call lower tax rates to encourage investment. Now we sit here now, we're producing the 2018 program for the 2017 filing season program. The tax laws may change. They may continue to change over the next 4 years of Trump's presidency. Keep that in mind as you learn about today's tax rates and tax strategies. This is going to be very fluid for the next 4 years. Capital gains generally involve the sale or exchange of what we call a capital item. So I'll use myself as an example. I'm a real estate broker as well. I own real estate. If I sell a building, that is a capital asset. It involves the sale or exchange of a capital item. But if I go into a property and I sell a certain small item in that property, that may not be a capital item for me. It may be ordinary income for me. Wages and labor are usually never capital gains, capital items, of course. Wages are always ordinary for the most part. And what are wages? W-2 income, right? 1099 income, that's what we consider wages. There are some extremely creative ways, though, to take advantage of capital gains. And we're going to talk about that in today's presentation, and you'll see that as well. So we're going to talk about things of that nature. I'm on slide 3. Let's first take a look at our ordinary income rates. So as you see on the top of this slide, I say ordinary. Now what we're showing you on this slide is your married filing jointly rates and your married filing separately rates. And the reason why we're showing you this on this slide is because the next slide we're going to show you shows you the capital gains rates as they apply to these categories. So look at the rate. If you're in the 10% bracket and you're married filing jointly, you can earn income up to $18,650. If you're in the 15% bracket, now the next dollar is what we call the marginal tax rate. So if somebody asks you, what is your marginal tax rate? Or if your client asks you, what is my marginal tax rate? It's that next bracket. So if they make $18,651, it is 15%. Is that their tax rate? No. The first $18,650 is taxed at 10%. The next dollar is taxed at 15%. So their actual tax rate is lower than 15% and much closer to 10%. But it's the marginal rate that most people get curious about. They want to know, when am I kicked into that next bracket, and can I lower myself down into a bracket? So look at 15%. That's $75,900. 25% goes up to $153,100. 28% goes to $233,000, 33% goes to $416,000, 35% goes to $470,000, and 39.6% is $470,000 or more. The proposal, as we produce the program today, the tax proposal in Washington is to limit these down to several brackets and to get rid of these multiple brackets and to remove the 39.6% tax rate. So of course, as tax return preparers, we are all watching the tax law to see what happens, to see if this gets simplified, reduced to 3 brackets, if we lose the high rate of 39.6%. So let's take a look at the next slide. So the next slide is the capital gains rate. So the capital gains rates that we have can be 0%, they can be 15%, and they can be 20%. And there's also what we call a surtax on those. Remember, the Obamacare law, as it was passed, has a 3.8% surtax on it currently, as of the date of production. That's going to change with the new tax law down the road. So when we tell people if they have a capital gain, if they're in a certain tax bracket, they may have to pay an additional 3.8%. So don't always just quote this rate and say, oh, it's 20%. And then they call me and I tell them, no, it's 23.8%. They're going to say, well, why did Roman tell me 23.8 and you told me 20? It's because we're not forgetting about that 3.8% bracket. Now, when do you face a 0% capital gains rate for your client? That is if they are in, looking at the married filing jointly brackets, if they are in the 10% bracket or the 15% bracket. I'm going to flip back a slide for a minute. If they're in the 10% bracket or the 15% bracket, they're in the 0%. They're going to pay 15%. I'm going to go back to slide 3 again. They're going to pay 15% for capital gains in the 25% bracket, the 28% bracket, the 33% bracket, and the 35% bracket. They're going to pay 20% in capital gains if they're in the 39.6% bracket. So now you see how those lay out. They are hooked to the ordinary income tax brackets. And that's how you know what your client will pay on a capital gains issue. Okay, moving on, we're on slide 5. So we're talking about capital gains versus ordinary income. When we talk about capital gains, look, there is an exchange requirement. Remember, I told you, it's the sale or exchange of a capital item. We know that a sale is a transfer of a piece of property. It can be real estate, real property, or it can be personal property, meaning a chair, a desk, a vehicle, personal property. You're selling that for money, a loan, or some other promise to pay you back. Of course, that's a sale. That can result in a capital gain. An exchange is a transfer of property for other property. We're going to talk about that later when we talk about the well-known exchange of a capital asset called a 1031, right? A 1031 exchange is what we know as an exchange of a capital asset. But look at what also can be considered a gain or a loss. We're really just talking about these in general terms. The cancellation of a lease. Payments received by a tenant for the cancellation of a lease are treated as an amount realized from the sale of property. The cancellation payments received by a landlord for the cancellation of a lease are essentially a substitute for rental payments and taxed as ordinary income. So look at the difference. If a lease is canceled on a tenant and a landlord pays the tenant money to cancel the lease, maybe they're moving in a better tenant, maybe they're moving in a higher tenant, maybe they're renovating the property, maybe they're going to tear the property down. They pay the tenant to cancel the lease. That's considered a sale of an item. That's capital gain to the tenant. But if the tenant pays the landlord to cancel the lease, maybe the tenant wants to get out early of their lease and the tenant says, I'll give you $1,000 instead of owing you $5,000. That's ordinary income to the landlord. So even though they're doing the same thing, it's treated two different ways. Copyrights. Payments you receive for granting the exclusive use of a copyright throughout its life are treated as received from the sale of a property. So they're a capital asset, capital gain. Interesting example I have here on a copyright. So I have a tenant. He's a physician. He rents an office from me. So he comes to me one day and he says, Roman, I want to put a sign on your building. I'm like, great, put a sign on the building. He shows me this drawing of the sign, and it's a stethoscope, and he's got his name inside of the stethoscope. Beautiful, artistic drawing. I'm like, Doc, looks great. Let's get that up on the building. So he puts it up on the building. Next thing he knows, the person that made the sign for him and came up with the drawing for him said, well, you can't use this on anything else. I own a copyright to it. I'm the one that produced it. You have to buy the copyright from me if you want to use it on business cards, stationery. I know. It was sort of an underhanded kind of sneaky thing to do, but actually they're right. They own the copyright on the product. So he had to pay for the copyright. However, we told him, we said, look, it's going to be a capital asset for you. It's going to be depreciable for you. Or we can sell it if you end up selling your practice down the road, we can add that item in as a non-taxable item because you paid for it, you're recovering the money for it, we'll benefit from it in the future. But copyrights can be capital items. What about easements? The amount received for granting an easement this is an interesting one. The amount received for granting an easement is reduced from the basis of the property. Now, in a few minutes, we're going to get into basis, depreciation, and adjusted basis. But let's make it simple. So I told you, I'm a realtor. I develop property. I'm getting ready to build a new strip mall actually right now. I have to grant an easement. I may have to grant an easement to the city for a sidewalk. I may have to grant an easement to the electric people to put in the electricity in the front of the property. Let's say the property cost me $100, right? Cheap property, right? $100. I grant an easement, and I'm given $10. What that does is that actually reduces the basis in the property. The amount received for granting the easement is subtracted. So now I'm down to $90. When I go to sell that property, if I sell the property for $100, I took a benefit from receiving that money. I took a benefit and reduced the basis in my property that exact $10 amount. When I sell that property for $100, I have to recover that benefit and pay what we call ordinary income tax on that $10. It's what we call recapture, and we'll get into that. But that's how easements are treated. Transfers on death are interesting. The transfer of property of a decedent to an executor or administrator of the estate is not an exchange that's taxable, and we know that. No taxable gain or deduction exists for a transfer at death. Don't get this confused with the estate tax exemption. So while transferring a property at death is not a gain, not a loss, the amount of value that's attached to that transfer does get applied to the person who passed away and the estate tax limitation that they have. You're going to see that slide in a little bit. And then, of course, bankruptcy. Generally, a transfer of property from a debtor to a bankruptcy estate is not treated as a disposition. Consequently, the transfer generally does not result in gain or loss. Let's move on to slide 6. So when we're talking about capital gains and ordinary income, we have to talk about depreciation. And depreciation always affects basis. So now let's take that same property. Now, instead of just saying, well, Roman, you bought a piece of property for $100. Let's say it's a building, and I bought a building for $100. Now, every year, I can depreciate part of that building. So I may depreciate $10 of that building each year for 10 years, or whatever my depreciation table is for that building for a commercial structure. But let's just say the depreciation is $10. It affects my basis. Now my basis is $90. That's what's called adjusted basis. I have adjusted basis because I took depreciation, otherwise known as, or what we call amortization of an asset. We also may have something called, as many of you know, Section 197 depreciation, which is an accelerated type of depreciation. So we may say, well, we bought a piece of equipment for $100. We're going to be able to depreciate all of it under Section 197. Now we take that deduction on our tax return, the depreciation expense, and now our basis is down to $0. That's how depreciation works as it relates to capital gains and capital items. And again, we're looking at this same terminology when we look at basis. So you've got to know from your clients, and really what's most important here to know, when you're looking at issues of basis, depreciation, capital gain, ordinary income, you've got to know what that item costs them. I can't tell you how many times a client has come to me and said, well, Roman, I did this or I did that, or I built a subdivision. I'm like, well, what'd you pay for it? I don't know. I paid $100,000 for the land. I put in sidewalks, roads, What did you pay for all of those items? All of those items get added to your basis. Those were all costs of the improvement of the property or of the piece of equipment or of the structure. Cost can get added to your basis, and then it can be depreciated. Any improvements that you make can get potentially added back to your basis. So ask your clients that, and then find out what is their adjusted basis in the property. One thing I like to look at, especially when I'm representing a client that has a business, is I want to see what we call their tax asset detail listing. Now, most of you are doing tax returns on software programs that will produce that form called a tax asset detail listing. If I'm involved with a business or I'm involved with a taxpayer that has assets that they are depreciating on their tax returns, I want to see that schedule. And you should get familiar with that schedule. In fact, most of the time, you are the ones that provide me with that schedule, as most of you are familiar with it. But keep that in mind, because it's a very important schedule when it comes to capital gains, depreciation, and adjusted basis. Okay, moving on, taking a look at slide 8. And what we wanted to do here was define for you long-term capital gains, short-term capital gains. The tax rates can be different. We gave you the general tax rates on long-term capital gains, 0%, 15%, and 20%, plus the surtax. But other capital gains that are short in nature can have different tax rates. And what you need to know right now is that a long-term capital gain is if your client held the asset for 1 year or less, and if they held it for longer than 1 year, it's considered a long-term capital gain. And it does affect the tax rates. So if you're looking at a client and they have a differentiation between the two, you need to take a look at the short-term tax rates on the sale of those items if they did not hold them for longer than 1 year. Okay, we're moving on. We're on slide number 9, and we're talking about wages. Now, I introduced this at the beginning of this presentation. Wages are not capital gains. They are ordinary income. As we all know, they are included on line 7 of IRS Form 1040. We just put this in there because there is substantial law on whether or not you can classify something as a wage or whether you can classify it as a capital gain. And penalties will apply if you, the tax return preparer, make a decision to put wages as a capital gain item. And most importantly, I made a note on this slide that I wanted to talk about was the difference between, you're not going to run into as big of a problem between wages and capital gains as you are between W-2 wages and 1099 wages. You need to make sure in counseling your clients, when they come into you and they say, well, I paid so-and-so and I 1099'd him. I did not pay him a W-2 wage. You need to make sure they've made the appropriate decision and that you're not counseling them into that decision if it's improper. We all know there's a big difference between an employee and an independent contractor, and the taxing that is different. As a wage 2 employee, the employer is responsible to withhold the federal, state, Social Security, Medicare, and state taxes. As a 1099 employee, the employer is not required to withhold those. When do you see the distinction? If the employer controls the employee, tells them when they have to be at work, tells them when they can leave, provides them all their tools and supplies that they need for the jobs, does not allow them to work elsewhere, they should be a W-2 employee. Whereas if the employer says, look, I just need carpet installed in these apartments, you install it whenever you want. I know you're working for other people. Here's where the carpet is. I've bought it already. You got your own tools. You have your own van. Go do it. Send me a bill. That's an independent contractor. That's really where you need to be careful when it comes to the area of wages, not so much with capital gains. So moving on to slide 10 and just looking at the topic of being self-employed. It's not a capital gain. This is also a huge red flag area for the IRS. If self-employment is on the appropriate form, it is not capital gain. And keep in mind, there's taxing strategies that we can use to get us away from self-employment taxes. And what are self-employment taxes? So if you have a client that says, well, I work for myself. Okay, so they need to pay in their half of the Social Security and Medicare tax. And they do that on the tax return. We all know that. We've all seen that. They do that right there on page 1 of their 1040. The self-employment tax is assessed. But I just wanted to throw this out there. If your client is a limited liability company and they're operating it as what we call a 1065 partnership, meaning you're filing a 1065 tax return for them, you're paying they're reporting self-employment tax on that tax return. They may not have to do that. There are certain circumstances where we do not have to report that half of the self-employment tax on a 1040. If they're operating as an LLC, we may have them restructure themselves as an S corporation or a C corporation and potentially not have to report that self-employment tax earnings that way and report it through the corporation instead of reporting it personally and getting the deduction through the corporation. Just keep that in mind when it comes to self-employment taxes. Okay, moving on to slide 11, and we're looking at capital losses. So there is a $3,000 per year loss limitation for individuals. If it's a company can offset its capital losses up to the extent of its capital gains, only up to the extent of its capital gains. But if it's an individual, there is a $3,000 per year loss limitation. Capital losses can be taken against wages, though. The effect, of course, if you're taking your $3,000 in capital losses against your wages, the effect is to do what? Reduce the ordinary income. And some can even intentionally take the losses, of course, at the end of the tax year. What do we all do at the end of the tax year? That's tax planning, right? One of the presentation slides today, we will talk about the definition of tax planning. It's in our company name. So we always do this at the end of the year. Take what expenses we can take, reduce our ordinary income, and do we have any capital losses that we can take against the wages? Okay, moving on to slide 12 and looking at gift basis. And what we do here, and what we want you to be careful with here, is that if property was given to your client as a gift, there could still be a basis in that gift. We want to look at the donor's basis and whether there is some gain or loss on that basis. So don't think, if somebody says to you, well, I got a gift from my father. Hey, what's your basis in that gift? Because if you go to sell that gift someday, you don't want to pay tax on the entire value of that property. Example, I have a client that called me the other day. He said, Roman, I own land. The land is worth about $500,000. It's farmland. He says, as a tax planning strategy, I want to give the land to my sons, and then the coal mine is wanting to buy the land. And I'll let the coal mine buy the land from them so they have to pay the taxes on it. Well, what's the first thing that came to my mind? Gifting. He's got to report the gift to his sons if it's over the annual exclusion of the gift. So I told him, I said, well, you can give them the property. They're going to get your basis in the property as a gift. If we file a gift tax return, we can at least report that to the government. You're going to start using some of your lifetime exclusions of gifts that you can make, and you're going to be okay. If you don't report that gift to the federal government, there can be some negative tax ramifications on the back end if the IRS comes back and audits that transaction after a time. So what you need to know here is that there can be a basis in the property that's even given as a gift. That way, when the sons go to sell that property or your clients go to sell that property, they're only paying tax on the gain, on the capital gain. They're not going to pay tax on the entire value of that property. Next slide. We are on slide 13, and we are discussing goodwill. Boy, I'll tell you what, the next couple slides, these topics, I could talk at least an hour or two on each topic. We use goodwill so much in the transaction of businesses across the United States. It's unbelievable. There are two types of goodwill. The first type is called enterprise goodwill, otherwise known as company goodwill. The second type of goodwill is called personal goodwill, and that is goodwill to the business owner. Personal goodwill is goodwill to the business owner. It has to do with the relationships they have with their customers and their suppliers. There's a difference between the two. Enterprise goodwill is ordinary income to the company if it's a C corporation. Personal goodwill is a capital asset to the individual. So if we deal with personal goodwill, it can be taxed at a capital gains rate. This has to do when we're selling a company, or if somebody's buying a company, buying a business or selling a business, and we want to get capital gain treatment on the transaction, we want to look at goodwill. Like I said, these topics are so heavy, I would love to get into more depth about these, but we just simply don't have the time. But personal goodwill, like we just talked about, it's capital gain. If someone is selling a business, you have to ask yourself the question to your client and contact a tax professional and say, can I sell my client's personal goodwill? I want you to look up the Martin ice cream case. This is where the concept of personal goodwill was created. So in other words, if you're selling a business and you're helping your client sell a business, and they're looking at a massive tax problem because of the sale of the assets of the company, you have to say to yourself, well, look, I want to get you capital gain treatment if I can. What are the ways I can get you capital gain treatment? Right here, this is one of them. There are a list of subsequent cases. I have a white paper. You're welcome to email me. I'll shoot you the white paper via email. It has the other current cases on it, and you can take a look at the analysis and where we're at in today's economic environment with the issue of personal goodwill. Just taking a brief look at collectibles, the capital gains tax, and I'm on slide 15, the capital gains tax on net gain from selling a collectible is 28%. So it has its own capital gain rate. And look what some of the examples are: gold, paintings, weapons, etc. Okay, briefly, I want to talk about, I'm on slide 16, for capital gains, I want to talk about a home. 99% of the time you talk about capital gains with your clients, it's going to be about the sale of their home. And you're going to tell them you're exempt. They're exempt from, if it's a single person, up to $250,000 worth of gain from the sale of their residence, $500,000 if they're married. Now, I know what's going to happen. Your client's going to come to you and say, I sold my house for $300,000. I have to pay tax on $50,000, right? Wrong. What's the basis in their house? They're thinking, I sold it for $300,000. I'm tax-free $250,000. I'm a single person. I'm tax-free $250,000. I have to pay capital gains tax on that other $50,000. That's not right. It's only on the gain. They're exempted $250,000 of gain. If they bought that house for $200,000, they sold it for $300,000, they only have $100,000 of gain, tax-free. You know that as the tax return preparer. It's just the way that has to be described to them. They have to know what's their basis. Now keep in mind, if it was an investment property they bought, and then all of a sudden maybe they started living there or something and they still want to fall into the residency requirement, you got to look out and see, did you do any kind of funny depreciation in that? Did you reduce your basis in any way? Did you have a loss that you took on your personal property and reduced the basis in your home to where the gain may be larger than what you think? But in general, that is the tax-free exemption on the gain on the sale of a home residence. And there is a limitation on that. Remember, they've got to have lived there 2 of the last 5 years if they want to qualify for that exception. They've got to have lived there 2 of the last 5 years. There are some exceptions to that rule saying, well, if we had it advertised for sale during those years, we didn't live there, but it was actively advertised for sale, then it will qualify. Okay, briefly, we're just going to talk about selling a business. There are 2 ways to sell a business: asset sale, which can cause ordinary income and capital gain, or a stock sale, which can be tax-free and capital gain. The 2 are fundamentally different in their tax treatment. If you're helping prepare a tax return where there was a sale of a business, or you're helping counsel a client where they're selling a company, pay very close attention to these types of rules. There's also a possibility in a transaction like that for what we call a 338H10 election, which is where we treat it like a stock sale and we get capital gains for tax purposes, but we technically sold the assets of the company and not the stock. There's also something that we do if it's a company formed after September 1st of 1993, and if they are a C corporation, it's called qualified small business stock, and that transaction can potentially be completely tax-free if they do one of those. Okay, I'm on slide 18. Real estate. Real estate as a whole, when you sell it, if your clients sell it, it can be treated as a capital gain if it's just a handful per year. If your client is selling more than 5 pieces of real estate per year, they may be treated as a professional, and it may be considered ordinary income. Let's take a look at slide 19. I'm looking at recapture. We talked about this a little bit. Capital exchanges can sometimes result in ordinary gain. It results when depreciation is taken. Take that $100 asset we talked about earlier. You took $10 of depreciation. You go to sell the property for $110. The first $10 is recapture, ordinary income. The second $10 is now capital gains rates. So if you've got depreciation on your books, your client has depreciation on their books, everything they allocate to that asset when they sell it up to its original cost is taxed at ordinary income. So they can't come into you and say, well, I sold a piece of equipment and I'm going to get capital gains treatment on it. Not necessarily. Did they depreciate some of that equipment? Section 1245 property, all I want to point out here is that it's treated a little bit differently. So you have to know, is the property that you're selling Section 1245 property? Typically, the problem here is that, let's say they're selling something on a contract for deed type of thing. The taxes, if it's a Section 1245 property, have to be paid up front, regardless of how long the payments are coming in for. So you have to make sure that you structure a transaction or that you're part of the transaction reporting that can pay the taxes on time, in full, and counsel your tax return clients properly. Other types of property, I'm on slide 21, just flipping through these, and that would be Section 1250 property. That is treated differently than Section 1245 property. So briefly familiarize yourself with those two different types of properties. Slide 22, I'm just looking at some of the different forms that are involved in our tax returns that we deal with when we deal with ordinary income, of course, 1040 and 1040X, 1099s, and then, of course, when we deal with capital gains, 4797, 8824, like-kind exchanges, and that's what we're on slide 23. I wanted to briefly talk about like-kind exchanges. Now, this would be what we call 1031. So 1031 is the form. It is Section 1031 for a tax-free exchange. I make a note and I say land for land because typically, if your client is selling a piece of investment real estate, and they don't know this, they can make a like-kind exchange of that property for any other type of investment property. It does not have to be identical. Real estate as a whole is real estate, and that's all that the IRS really looks at. If it's a non-real property, then it must be matched by class. What do I mean? If it's equipment in a facility that they're selling and they want to buy new equipment under a tax-free 1031, then they can't sell equipment and buy real estate. They have to sell equipment and buy equipment. But real estate can be sold and exchanged for real estate. Now, the one caveat I want to point out about a 1031, we all call it tax-free. And look at even the title of our slide says tax-free, and that's really a misnomer because it is simply a tax deferral. When your client sells a piece of property and exchanges that for another piece of property, now they have what we call the replacement property. When they sell that replacement property, if they don't do another 1031, they have to do what? Pay the tax on the original transaction. It's a tax deferral. It is not you are out of the tax forever. It is simply a tax deferral. Please keep that in mind when discussing that option with your clients. So in conclusion, as you saw from the tax rates, capital gains rates are highly desirable for us. Anytime your client and you can take advantage of characterizing income as capital gain, we want you to do so. The IRS wants you to do so. Be careful of depreciation recapture rules and understand that so that you can talk fluently with your client about that. And if your client is selling something, explore the possibility of a like-kind exchange. I handle a lot of them every year, and so many clients forget about that possibility of a like-kind exchange. If you have any questions, here's my contact information. Thank you for attending this part of the presentation.